guys, welcome back to the channel. My name is Stock Brock. Today I want to break down the Netflix stock split. So we have a Netflix stock split coming up. Say if you own the stock by November 10th, you will basically get 10 shares if you own one share. So it's a 10-for-1 forward stock split. So if Netflix is trading around $1,000 like it is, after the split, each share would be around $100. Same total value, just more pieces. Think of a piece pizza. Say if you own one share, one slice of pizza, it'll turn into 10 slices. So it's going to be the same amount, same value. But I think the reason they want to do this, as they mentioned, is make shares more accessible to employees in their stock option program and more affordable to retail and individual investors. So it's not about just raising money or changing fundamentals. It's more cosmetic and accessibility move. Here's the big question. Why do companies even do this if it doesn't change the value? It's mostly psychological. When shares trade at a really high price, say $1,000 like Netflix is now, new investors might feel priced out and not willing to invest. By lowering the price per share, it feels more affordable, even though fractional shares already exist. But for companies like Netflix, Apple, Tesla, splits also signal confidence. They usually happen after strong growth for the company, when management wants to reward shareholders and make ownership more inclusive. Netflix also did a 7-for-1 stock split back in 2015, and before that, a 2-for-1 back in 2004, both during major growth phases for the company. What happens after a stock split? Historically speaking, more often than not, stocks that split outperform the market in the year that follows. According to the NASDAQ and Bank of America research, companies that split their stock average about a 25% to 30% return in the 12 months following that announcement, roughly double the S&P 500 typical return. Why? More increased retail participation, momentum, and optimism. For example, Apple's 4-for-1 stock split back in 2020, shares jumped over 30% in the months that followed. Nvidia's 10-for-1 stock split in 2024, you know the rest for Nvidia. They didn't just basically grow just because of the stock split, but maybe a little bit of a factor. And even Amazon and Tesla saw big waves of buying activity right after their stock splits. But remember, this isn't always guaranteed. A stock split doesn't fix weak fundamentals. It makes the price per share smaller. If you already own Netflix, congrats. You'll automatically get 9 extra shares for each one you own. You don't need to do anything. If you're thinking about buying Netflix because of the split, just remember this does not make the company cheaper, only the price per share. So you want to do your homework and value the company before you buy it. So always look at the fundamentals, not just the share count. If you believe Netflix has a long-term growth ahead and is the future of streaming, to ads, to gaming, this split might be an opportunity to pick up some shares, maybe before, because it's going to be the same value. But yeah, guys, thanks for watching. Hope that explained it for you. My name is Stock Brock. Peace.